so much, Rick. I appreciate it. Hello, everyone. My name is Anastasia, and I am a mortgage broker with AMS Mortgage Services, known as Your Loan Queen, and your affiliate in action here. And today's topic is something that I really wanted to talk about, and I so much appreciate my personal tax advisor. She does my own taxes, who can jump on here and demystify the tax deductions. I think I see a lot of the times realtors file their own taxes and they use all of these online tax tools and they think they're doing themselves justice by saving a couple $100 and they're leaving so much money on the table. And I see it so often, especially when these same realtors try to then buy their own properties and then they're confused as to why they're paying too much tax or why they're getting audited. So today's conversation is kind of timely. I want to make sure that, especially for this upcoming next tax filing in 2026, or if anybody hasn't filed their taxes and still needs to file, I'm sure Berenice needs new clients. So here we are. We're going to start right now. And then, of course, if anybody in the audience wants to ask questions, we are going to have, I hope the chat box is open, so that way whoever's in here can ask. So we're excited to welcome Berenice Chavarria of Chavarria Tax and Business Solutions, a trusted South Bay tax professional known for her personable approach and dedication to helping both individuals and small businesses thrive. Born in Mexico City and raised in Torrance, California, Berenice graduated from CSUBH with a bachelor's degree in business with a focus on accounting. Her professional background includes preschool teaching, sales, and eventually finding her passion in bookkeeping and tax preparation beginning in 2020. She started part-time at a small firm in Culver City, and by 2021 had subleased a tiny shared office. And through hard work, determination, and genuine passion for helping people, she opened her very own full office in Harbor City in the fall of 2022. Today, Berenice and her team specialize in tax preparation, bookkeeping, payroll, business solutions, while creating an environment where clients feel supported, educated, and financially confident. She personally handles my own taxes. Yes, she does. And I could not be happier with her services, which is exactly why having the opportunity to learn from her today about tax saving strategies is so valuable and exciting. I'm excited. So whether you're excited, that's on you. So Bernice, let's jump into it. I know I have like seriously so many questions because taxes, people are so afraid of them. It's almost like they don't know what to do with it. And they think, and I think there's a lot of money that is left on the table, as I mentioned earlier, by not hiring the right professionals who keep in touch with the current tax laws, which do change annually at times, right? Like how often, tell me like your process of like, how do you find out when there's a new tax law, for instance, that's going to affect the upcoming tax season? Like, how do you find out about it?
Well, first of all, good morning, everybody. And Anastasia, thank you so much for inviting me and and you guys for joining the meeting and giving us your time. Hopefully you guys can learn something new. And if not, at least give some of the things that we'll talk about some thought, and feel free to reach out with any questions later. But to get right into it and answer that question, it's funny because I think sometimes the first thing that we usually hear about something new or something rumored, believe it or not, is through social media. Of course, that's not what I go by. And then I start, emailing to all my clients like, hey, guess what? You'll be able to deduct this. No. First, I'm guilty of, going to social media and seeing what people are saying, what the buzz is all about. And then I go to the IRS website. I usually get my news directly from them. And if there isn't anything posted yet, then, again, it could just be a rumor. However, if anything is actually solidified, the first thing I do is go to the IRS website to try and understand what it is that, is being implemented, or what it is that's being, what the rumors are about, so to speak. I go right to the source, because you definitely don't want to and especially me as a tax preparer, I don't want to go off of what social media said, no matter how many times it
Mhm.
was said, and no matter how many times the same thing was said. I go straight to the source. And so
Yeah.
a lot of the times, I get asked questions like, "Hey, I heard this, and I haven't heard about it." So that's always my answer is, let me go
Yeah.
straight to the source. When I know something concrete, I will confirm or deny.
Yeah, yeah, because sometimes it's a denial as well. Not everything on social media is true. Sometimes it's
Correct.
just a bait and switch, they try to get more looky-loos on the reels. Okay, so
Yep.
jumping right into it, how can independent contractors, which all realtors are,
Mm-hmm.
legally minimize the amount of taxes they owe while staying compliant with the IRS and California tax laws? It's mainly to do with being audited. Realtors are always like, how skinny can I make my taxes? If my gross income is 200,000, can I show that my net income, taxable income is 20,000? Is there a percentage? Is there like, what does the IRS look for, in terms of maybe the ratio of deductions for independent contractors? Or is it the amount of money they earn versus the amount of money you know, is there a ratio, or is this all a myth?
I wouldn't say so much an exact ratio, but your tax return has to make sense. If you made 500,000 but you netted negative 100,000, well, something could be wrong there. So it has to make sense. Again, not so much a ratio, but also, are you expensing a ton of miscellaneous deduction expenses, or are your categories on point? So what I always tell people is, if you're going into tax season with, oh my gosh, I made so much money and I know I had some expenses, but they're not organized, you're already going into it wrong. You should be, and I know sometimes people say, well, I don't make enough, or, my expenses aren't that scattered where I don't need a bookkeeper. You don't have to hire a bookkeeper, but you do have to do your own bookkeeping and keep good records. Now, that doesn't mean that, December comes along and you think, oh, well, I'll do this the first couple of weeks of January. No, that
Yeah,
means
exactly.
every month,
What's the
sit
best
down.
way to keep track of the expenses? Especially with related to mileage, because I know that's a biggie.
Mhm.
What's a good, if somebody is not organized, how would they start today? Because it's daunting during tax season to try to come up with these
Oh, yeah.
deductions. And I think most of the time the realtors are like, well, I think I spend $300 a month on gas, and then it's all it's not based on any actual receipt. So what would be a good way, would you say, to start today? If today was day one and you haven't been keeping track, what do you recommend?
Well, the first thing I recommend is to make sure that you have a business bank account, whether you're operating as a sole proprietor, whether you have an LLC in place. Make sure that you get yourself a business bank account, because, if you have your expenses, you have your business, you have your personal all commingled into one, even if you have great records, what the IRS can and might say, well, this is a personal bank account. How do we know that this isn't, even though you purchased something at Office Depot, laptop to conduct business out of, how do we know that it's not a personal expense when you're not actually doing yourself the favor of splitting it? So my first suggestion is always get yourself a bank account. Get yourself, again, a DBA, sole proprietor, LLC, which, not necessarily jump straight into that, but find a way to differentiate: business bank account for business expenses, personal account for, your daily Starbucks, dinners, everything else, groceries.
Yeah.
And then back to how to actually keep track of it. You don't necessarily have to go into, like, for example, QuickBooks and start paying a monthly fee. Sometimes I've seen very well organized Excel sheets. Income on one side, expenses on another. If you're not sure about how to categorize, feel free to reach out. I can send you some categories that are used, especially specifically tailored for realtors. I'm happy to share
Mhm.
those. But I mean, think of your very basic ones: your cell phone, your internet, your office rent, your license renewal, whether it's on a yearly basis, bi-yearly, whatnot. I'm not too familiar with the real estate and how often you folks have to pay, but those are the first ones that come to mind. And
Yeah.
then anything else
And then
that
I'm
I,
sure with open houses, marketing and all of that,
yeah,
also is a contributing factor to all of the taxes of
whatever
the
it is that you pay out
event.
of pocket, whether it
Yeah.
is the signs, your business cards,
Yeah.
those are your very basics.
Would they have
But
to keep
there
actual
are
receipts
more.
if it's itemized in the bank statement? Do you, as a bookkeeper, need to see actual receipts for those items purchased, or would having that line item in the bank statement be sufficient for the purposes of if you are being audited, would the IRS need to see actual receipts, or would the bank statements be sufficient?
That's a great question. And the way I think about it, because me personally, I'm for my corporation, how I handle my business, I'm not I don't always save everything. And I'll tell you what I do save and why do I might not. So if I went to Staples, purchased, a case of paper, more than likely I'm not buying anything personal out of Staples. So if I lost that receipt, I'm not too worried about it, right? Now, if I went to Costco and purchased the same case of paper, that receipt I will keep. Why? Because Costco is a more, I can buy anything at Costco. I can buy my groceries, I can buy my wine for the weekend. And so if the IRS were to say, audit that particular line of Costco, that's more questionable than Staples. Does that make sense?
Uh-huh. Yeah, no, for
So
sure.
that doesn't
And then
mean be careless.
how long would one need to keep these receipts on hand? What's like the timeline of audits? How far
3 years.
can Okay, okay. So that's
3 years.
not too many
It's not
receipts.
too bad.
Okay.
Now,
Yeah.
if you, once you set yourself up correctly, get yourself a mini scanner and take photos and scans of those receipts for that particular year. They fade, we can lose them, we move, the shoebox gets lost or whatnot. So get into the habit of scanning and saving. And if you have to,
Mhm.
highlight that one item, if you didn't have your business card with you that day and you purchased, and you had to commingle a purchase, make sure you highlight and differentiate what was for the business and what was the personal.
Awesome. Awesome. Well, thank you. Thank you for that. Moving on, at which point does forming an LLC make sense financially? Because, obviously it costs money. And then at the same time, there's liability benefits as well. Because, the biggest myth here is if I form an LLC, I automatically pay less in taxes.
Mm-hmm.
That's what I hear a lot. So tell me when it makes sense. Would a brand new agent start an LLC right away, or would you have to have a sufficient amount of business in order for that to make sense financially?
Well, that's actually a very good question as well. And that's the biggest misconception is having an LLC protects you from tax. It's almost like the way social media has portrayed LLCs is that you get extra write-offs and you don't pay as many taxes because you get extra write-offs, but that couldn't be further from the truth. So when we start when we start a business as entrepreneurs, we have different options. We can go into it as a sole proprietor, just operating under a social security number. You can do what's called the doing business as, where you file with the county, very low maintenance, no yearly fees, nothing like that. But you can, have that DBA. So I would be like, for example, Berenice Chavarria doing business as Chavarria tax, right? Again, no yearly fees to pay. I can go and get an EIN, go get a business bank account and operate that way. So that when I go
Mhm.
do my tax returns on my personal, I'm showing the IRS that it's almost like you're showing effort, right? You have something set up, something official, and that way it's less questionable. Now, the LLC will give you liability protection as long as you operate it correctly. So now going back to the first example that I was giving you guys about commingling and not having a business bank account. If you have an LLC, but you don't have a business bank account where you're operating out of, you're not giving yourself the full legal veil that the LLC should be giving you, right? So if you feel like you have assets to protect, you're a homeowner, you have a spouse, you guys have retirement accounts, you think something could potentially go wrong. You might not do anything wrong, but California, we are known to be a very sue happy state, unfortunately. And it's also a very expensive state for that. So now, how do you decide if you're ready for the LLC? One, consider your assets. Consider what's behind you: vehicles, cars. Vehicles, homes, retirement accounts, family. And if you think, okay, well, there is something that I should be protecting there, look into consider the fact that California charges LLCs $800 a year, whether you have net income or you actually lost money on your business. So that's one thing to consider. Tax returns are usually a little more expensive as well, because even though the IRS doesn't see the LLC as a separate entity, California does. So now you're filing an extra return. Now, so,
would that be true with the DBAs though would not have that $800 charge? So
correct.
you would still have a layer of protection, at least the separation between private life and business life. So the
Yes, but
DBA
not
could
legal.
be
With a
a good starting
DBA,
point.
correct. There's
Yeah.
no legal protection there, but at least you
So for
are
sure do
separating.
that at the very least, right? It should not just be a realtor operating in their own name without a DBA. Would you say that's an accurate statement?
I would recommend it
Even
for
from the
anybody that's
beginning.
doing correct. Yes.
Yeah. Okay. And
Again,
then
very easy for it to
what
be.
about S Corp or like besides the LLC, is there other corporations or other ways of integrating, I don't know, if somebody's managing, let's say has multiple agents in their office and now they've become a broker, what would be the next step in that process if you're not the sole agent in the office?
If you're well, so back to the original example, though, I'm going to
Yeah.
backtrack a little bit. Once you say, okay, well, I'm making this much money, because it's sometimes different accounts will have different opinions on how much you should be making in order to go from an LLC and actually have it taxed as an S corp. Now, where the savings are, again, sole proprietor LLC, IRS doesn't differentiate. So any positive income that you have from there, your net income is anything what you actually took home. So anything, what the brokerage paid you, your expenses, that's your bottom line, your net income. That amount, as a sole proprietor or as an standalone LLC, will be subject to 15% self-employment tax automatically. If anyone knows what self-employment tax is, it's basically your Social Security and your Medicare contributions. So
Mhm.
that actually brings me to another point there. As sole proprietors, we're always told to put away at least 25% of our earnings for tax. But does anybody know why that number is? It's not because the IRS automatically wants to take 25% from us, although it may seem like it. But what it is, that breakdown of that 25% is, again, that 15% self-employment tax, your Social Security and Medicare contributions, and 10% for base income tax. Again,
Okay.
25%. So when you go from an LLC to an S Corp, S Corps are not subject to self-employment tax. So any income from there, which again, you are the owner, but you're now known as a shareholder, any income from that is not subject to self-employment tax. So
Okay.
right off the bat, that's where you're saving at least 15% in taxes. There are other
Mhm.
implications. Again, feel free to reach out for some details regarding that. But that's where your savings are. Again, different accounts have different opinions on how much you should be making in order for
Yeah.
that S corp selection to be worth it. Usually 50, 60,000 is what most accounts agree is that the sweet spot where it's worth it for you to
So create an S corp if you're making at least $50,000 in income annually.
correct. Or if you have
Okay.
an LLC already, have it taxed as an S corp, because remember, an LLC standalone to the IRS doesn't mean much. You have to
Okay.
elect for the LLC to be taxed as a corporation. More importantly, an S corporation.
Okay, perfect, perfect. And then, one of the biggest things we were talking about the G-Wagon thing, I'm going to bring it up. Buying a G-Wagon means it's free because it's a write-off, or any type of car. Can I write off 100% of my car payment off of my taxes? Can you elaborate a little bit about this social media trend that's going on? If I buy a 6,000 plus pound vehicle, just the government is just going to pay for it. So
Um, so yeah, that one was definitely a favorite. I think some video went viral about a girl buying a G-Wagon and completely writing it off. Well, I mean, sure, but you still spent money on it, right? And so, first of all, if let's say the vehicle cost $100,000, and you wrote it off, even and with if all the right conditions are met, and you took $100 expense. Well, did you make $100,000 to begin with, or are you just putting yourself at a negative? So now, even if you're at negative income, you haven't paid any taxes. You definitely don't owe any taxes at the end of the year if you have negative income. You're not getting any money back. You just congratulations, you spent $100,000 to show that you made no money. That doesn't make sense. And again, even if let's say you made $200,000 and now you have $100,000 write off, you met all the conditions. I guess you really wanted the vehicle. If you already had, let's say, 50,000 of expenses and now you're adding an additional 100,000, how much is that really saving you? Is it putting you in the negative? Is it saving you a couple $1,000s? So if the strategy is to, spend $100,000 to save 5,000, that doesn't always make sense. And I'm speaking in very general terms, but that's really what it comes down to. A lot of the times we meet
yeah,
with
because the
clients.
100,000 is a deduction against income. So first off, if
Correct.
if
But
somebody
it's still
has no
money out of your
income to show, then it's not a deduction. It's not like the government's suddenly going to hand you a check,
exactly. Yeah, you're just
for the
because you
difference.
you had a
So
hundred thousand
that
dollar
really
write off,
doesn't
you're
make
not
sense
getting 100,000
mathematically.
refund.
Right.
Yep,
So somebody should
correct.
not get a significantly more expensive car that they can already not afford just to get this deduction,
Just to
which
get the write
is
off.
exactly doesn't really typically make sense, right? Um,
Correct.
so another question I get asked is, if I get audited, does that mean I did something wrong? Who are they
Not
targeting when
necessarily.
they're auditing people?
I've seen uh, various letters. I haven't seen many asking for. Actually, I haven't seen any in my short career with the IRS asking for actual receipts or actual
Mhm.
justification of expenses. Part of that could be because we're very good about categorizing things. And if you tell me something's an expense, fine. I always tell people, make sure you have your receipts, make sure you're able to prove this deduction. If it looks like it could potentially be a red flag to me, I'll be very honest with you and let you know that. And if you say, here's my receipts, this is what it was for, perfect. Then we have nothing to worry about. The IRS is not as scary as most people may think. You will, if you do get audited or if they're just looking for additional information, everything will be by mail. So you will never get a text message from the IRS. You'll never get an email asking you for, verification. It will always be by mail. So,
Mhm.
make sure you have that in mind. Once you do get a letter from them, it will explain everything. Now, even me, sometimes I have to read it, two, three times to really figure out what they're asking for. But they do give you a chance to explain yourself, so to speak, right?
Mhm.
And so a lot of the times they just want to see, you know, a copy of your W-2. I've seen that a couple times, as silly as it may sound. They have records of it, but for whatever reason, sometimes they just want you to send it in.
Yep.
So any letters that you may get from them, sometimes it's like
Just
miscalculations.
don't ignore the letters. I think that's the tip, right? Never ignore the IRS
Never
letters.
ignore the IRS. Never ignore the
Right.
IRS. Reach out to your
Yeah.
accountant if they won't help you. reach out to us. We could at least say, okay, this is what you need to do, fax them X, Y, and Z, and you'll be good to go. But
Yeah.
never ignore the IRS.
Yeah. What about for real estate investors? Let's say maybe a portion of the income they get from getting rental income, they get in cash. Do those cash payments, are they invisible to the IRS? How would the IRS find out if certain income is being paid in cash? And what would be your recommendation in that case?
Well, well, we are required to report any and all income, no matter what form, no matter the source. So if I'm me as your tax preparer, if you're telling me, oh, they paid me $10,000 in cash, I have to report that once I know about it, right?
Mhm.
That's my due diligence, and that's my duty as a tax preparer. Is it
Mhm.
invisible to the IRS? Maybe. You know, what I recommend is be honest with your accountant. Um, if something is questionable, you know, but bottom line, we report everything and anything and from any source.
Yeah, perfect. And what would you say is the biggest flag in the types of deductions? Like I heard that a home office deduction will automatically trigger an audit, or you're being put on some blacklist somehow, by having a home office.
Clearly.
But so many people now work from home that I'm sure you've seen an increase in home deductions, even since COVID. Because I mean, I have a home office. Why not? Now less people are going into the office. So what would you
Yeah.
say about the home deduction? How does it need to be classified? Does it need to be a separate bedroom, exclusively used as an office? And how would you apportion the different, between electricity and the phone bills and all of that and the Wi-Fi? Um, how would you recommend someone would set that up if somebody does have a home office?
Okay. So with that one, there's a little bit of misconception out there that anybody that works from home, whether you're W-2 or whether you're self-employed, that you can get a deduction. Now, for W-2 employees, there is no home deduction, and this has been the case since like 2017, 2018. That even if you work from home full time, even with and after COVID, there's really nothing to write off working from home. As a self-employed individual, independent contractor, absolutely you can deduct your home office expenses. And how that's done properly, and your accountant should be asking you these questions. I always ask people, and I always say, I'm not trying to be nosy, but this is what I have to ask in order to get you this deduction. The square footage of the home itself and the square footage of the dedicated office space or room. It could be that you have a full room dedicated just to the office. So that generates a percentage. 100,000 square foot home, you have a 150 square foot office. That's what, 15%, right? So now 15% of what you paid in yearly, what you paid in rent throughout the year, what you paid for your electricity, your renter's insurance, for example. 15% of that yearly total is what you're going to be able to deduct if you have profit on your business, or whatever it is that you're doing. Um, the red flag comes in if you're trying to claim, for example, like, and again,
50% of your
correct,
house, right?
correct,
Yeah,
and
have it being an
usually
unreasonable percentage, right?
correct. So I like to think that 15-20% is a good number. Anything above that is questionable. I know for a fact, I I definitely use a very small space. Even though we do have at my personal home, we do have a spare bedroom that we say it's the office. My husband uses it. I rarely use it because I come to the office to do all my work. But I me personally, I would never use anything higher than 20%. That could
Okay.
potentially be a red flag. And I'll give you one very peculiar example. I do have a client who takes a much higher deduction. He is retired and he sells things on eBay. He goes, to estate sales, anything that, old magazines. He has crates, I mean, not crates, but like storage totes of all his inventory, mostly at his house. So he takes a larger deduction. I always advise against it. If the IRS were to audit him and maybe go to his house and actually see that all of this is used for work and inventory, and he's constantly uploading inventory, selling, shipping, and going through these crates where, wherever this 1950 magazine is found, then they'll probably um, allow it. But again, it's a very particular, specific case.
Yeah.
I'm sure are using 50% of our home for office, though.
Yeah, for sure, for sure. And then I have a question in the audience. If I have an LLC but not used it yet, do you still have to file tax on it?
Yes. Was it formed here in California?
I guess that would be a
Um,
follow-up question for Dalal. Was
yes.
it formed in California? Yes, it
Yes.
was.
So that's just California being a very, again, expensive, aggressive state. Whether you use your LLC or not, you are responsible for filing a tax return from the year that you opened it up. So if you opened it in 2025, we're doing 2025 tax filings now. Yes, you still have to file a tax return on it, even if it's a zero return. And then, of
Mhm.
course, pay the $800 yearly tax that they're liable for to the state.
And another question comes up is with the tax filings. Some people I know file late and they don't get an extension. What's the positives or negatives of do we need an extension? Is that an audit? If you don't get an extension, you file later in the year. And I know a lot of it depends on somebody's W-2. And if you file late, it's almost irrelevant that you do file late. There's not really any penalties because it's unlikely you owe tax to the government. And the government is not going to go back and say, wait a second, we owe you, $20,000 for 5 years of unfiled taxes if you are an employee. But I know there's bigger punishments if you are an independent contractor and you don't file taxes timely and you don't get an extension. What are the penalties for that?
So for anybody who is under my client list, if whether I've heard from you or not during the very first couple months of the year, as we get closer to the deadline, I will always file an extension for you. I give you that as a courtesy because especially we don't know whether you'll owe or not. Most people, like Anastasia said, if you're a W-2 employee, you are at least paying some taxes, unless you went exempt throughout the year, which I have seen. I never recommend that you do that, but under a W-2, you are being withheld at least some taxes, right? So you're almost safe there. That doesn't mean that W-2 employees don't pay. But what the extension does is it takes away the non-filing penalty. Um, Now, it's important to note that when you don't owe, there's no penalties for filing late. However, if you are owed a refund, you only have 3 years in which to claim such refund. So right now,
Mm.
2025, 2024, 2023 are the 3 years that you can claim a refund on. 2022 and back are unfortunately forfeited. So even if you think, well, I
Wow.
don't owe, I withheld, make sure you file your taxes. If you're owed a refund, get that money back. And so again, no penalties if you
Definitely.
don't owe.
I wonder how many people actually know that. I mean, I actually that's one thing that I didn't know, and I thought not that I know everything, but I thought that's a new one for me. I didn't realize that you only
Mhm.
have 3 years to claim your refunds, for
Yep.
employees. That's a really good tip
Yep.
there.
Yeah.
Um, okay, perfect. And then,
So,
can you tell me a little bit about meal expenses? Is this like something new that's coming up where meals are no longer deductible, or are they? Oh, we lost Bernice.
oh
I know I'm
no.
not a tax professional. Bernice, are you
Um,
still there?
yeah.
Oh yeah, you're still here. Okay, perfect. I just think the camera
I
just
don't know
turned
where
off.
my baby went. Sorry, I don't know where my
Uh,
baby. That's
No, no,
weird.
you're good. As long as we can hear
Hear
you.
me?
Because I thought we lost you, and I'm like, I can't conduct the text
No.
class by myself. Um, but as long as we can hear you, or do you want to maybe log back out or in? Let me see. I'm wondering if how we
Let
can.
me see. If you can, I don't know what happened to, it said
No,
it
no, it's
changed.
okay. We can still, and we're going to be wrapping up anyway. So the follow-up question with Dalal was regarding the LLC question was so um for example, assuming 5 years, um the individual would pay $800 times five if there's no um taxable income from the LLC. Is that correct? Because the maintaining of the LLC alone requires an $800 investment annually, right?
That is correct.
And if one doesn't pay the $800, does it continue to like add up? So 800 times five
Unfortunately,
in
it
this
does.
case.
Unfortunately, it does. I mean, you have to follow a procedure if you were to want to shut down an LLC back from when you actually opened it. I
Hmm.
have been able to do that before. It's a timely process, and it does take a lot of proving. But yes, unfortunately, California is very unforgiving. If you opened up an LLC 5 years ago, that means 5 years of tax returns, 5 years of $800. Unfortunately, it's not just a flat $800 per year anymore. Now there's penalties and interest attached to it.
Yeah, so
So
definitely file your $800.
pay your eight hundred
Yeah,
dollars. Dala, feel free to reach out. I can
yeah.
guide you through at least,
Perfect. Yeah.
what
And
you
maybe you can
have.
even, Bernice, drop your info in chat. So for those
Yeah,
individuals who are on this call can at least reach out. I mean, again, as a tax professional, you have been amazing with my own personal taxes. And I continue to recommend you, to everyone I meet. So a
appreciate it.
couple last questions wrapping up is, I know with the big, beautiful bill, there was a lot of controversy related to certain things related to taxes, but some of the things that came out of that bill related to real estate was a positive thing. One of the things was the SALT tax. So now there's a larger deduction for that. If you can elaborate what that means. Because I know it went from 10,000 to 40,000. So for somebody who is a homeowner, what does that mean?
Yes, so actually, we saw a very positive impact on a lot of our clients, especially homeowner clients here in California. Because if you think about it, $10,000 of state and local tax known as SALT, a $10,000 deduction wasn't much, especially here in California. We pay at least, I don't know, $11,000 of property taxes if you really bought your house. No, don't send.
Are you there, Bernice? That was a good one. That was a good topic, right? Like a cliffhanger. Like we're watching a movie and we're like, what happens next? Bernice, are you there?
She's coming back on right now. Yeah, she dropped
Oh,
off.
okay, perfect. I'm like, the cliffhanger. My best question left for last. Uh, yeah, because I think that's the salt deduction, and then also I want to ask her about the mortgage insurance. That's going to be a deductible expense as well in 2026 tax filing. So for those buyers coming in with um, anything under 20%, they'll be able to deduct the mortgage insurance off of their taxes now. So it no longer can be used as an excuse for not buying a house and trying to save for 20% if they, in fact, can, again, deduct that mortgage insurance payment off of their taxes, off of their income. And hopefully they have income to deduct. Otherwise, they won't be buying a house. So, well, maybe, I don't know. I will give her a couple. I think I just saw her log back in. Bernice, are you back? Maybe we can wrap up because it sounds like we're having, unfortunately, technological issues right now. If not, then yeah, it's okay. We'll just, how about we'll have round two? Because it's been a very informational topic, and I appreciate, Bernice for allowing us to pick her brain. And I think it's a good dive into all things taxes. And if somebody has any questions um, related to taxes, we can have Rick when he sends out the recording, he can send out Berenice's contact information. There it is. She just put it
I'm
in the
back.
chat.
Sorry
So,
about that, guys. I don't know what
oh,
happened there. Here.
oh, there it is. No, do you want to come back really quick about the salt deduction? So now you're
Yeah.
able to have the larger percentage of the tax. Explain again. You're kind of cut off halfway through because I think it's
Sorry
very
about that.
important for everybody who does own a home or who manages clients' rentals and all of that.
It is so SALT, state and local taxes. For California, with our taxes being so high, we were already at a disadvantage, only being able to write off $10,000 of that, because that has been increased to 40,000. A lot of our clients saw a very positive impact on their itemized deductions. You know, going from a limit of 10 to 40, that's an additional $30,000 of less taxable income. So that in itself was a very it had a great impact on our clients, and I'm sure most people anywhere really will be able to deduct charitable contributions starting this year. We thought it was last year, but it's actually this year, even if you don't itemize. So
Nice.
keep record of your donations starting this year. Before it didn't make a difference, but this year it will. And yeah, so
And
again,
then what about the mortgage insurance? Is that true that in 2026, not last year, but it's going to be from this year on. So for
that is
next year's
correct.
filing, mortgage insurance, which with FHA loans or any loans under 20% down payment, the homeowner paying mortgage insurance to the lender is able to now deduct that as
That is
again one
correct
of the
as well.
deductions. So it can no longer be. That's what I was saying. It can no longer be an excuse to say, okay, I'm going to wait to save for the 20% down payment. And that's actually for me has been the biggest blessing in the way that I speak with clients is you don't need 20%. You can deduct the mortgage insurance off of your taxes. It's no longer a relevant
Starting
excuse
this
not to
year.
buy a home. Yeah,
Yeah.
exact. Perfect. And then
Yeah.
any other little tidbits from between this year's and last year's filings that you think most people miss or most people were not aware of that you've seen make a big impact saving clients funds related to real estate mainly. Obviously we're all real estate professionals here. Any other like
Um,
major things, or is it kind of case by case specific? And I think that's where individuals should reach out to you if they need additional advice pertaining to their own taxes.
it is case by case. Everybody's situation can be very different. But that made the biggest impact as state and local taxes.
Yeah.
Unfortunately, not everybody is a homeowner, but for those who are,
Yeah.
they were used to sometimes not being able to itemize.
Yeah.
So what I always tell people
Perfect.
is, always have records of everything, present them to your accountant, and have them double check, because the situation can change from one year to another. I
Perfect.
see that
Well,
there are some questions about meals. Really
yeah.
quick, typically our everyday Starbucks are just because we're stepping out for lunch while we're working, even as an independent contractor, that doesn't mean that it's deductible. And this is a very, by the book answer, but we still gotta eat, whether we're employed or not, whether we work under a company or whether we're self-employed. So typically meals for ourselves, no, not deductible. Meals with a client, meals with a potential client, celebration meal after the closing of a deal, yes, they are deductible at 50%. So, put the whole thing on your card. Your accountant will take care of splitting it.
Yeah. And what about and then the last question to wrap up is gifts. Is there a cap for how much the gift can cost? In terms of how much a realtor can give? Can they give out TVs and, trips to whatever Lakers games or
Well,
Olympics coming up, right? Olympics
gifts are
tickets for
actually
everyone.
very that's another one that there's a misconception that if you spent $1,000 on season tickets, that's a gift for a client. No, it's actually a very small cap, and that's $25 per gift. There is a little bit of a way around it. It could be a marketing tool. So, I've seen people where they make wine bottles with the label as their logo or their business card turned into a label of some sort. And then you can get away with a little bit more if you're using marketing materials. So be careful with that as well. But yeah, I do feel like there's a little bit of creative flexibility there.
Okay, perfect. Sounds good. And so, yeah, we're going to wrap up here, Rick. Thank you so much to Berenice for the wonderful insights related to taxes, and we'll see you on the next one.
Thank you so
Bye.
much, Anastasia. Thank you for your time, everyone. Have a great day.